Have you ever wondered what exchange-traded funds or ETFs are and how they work? Well, put simply, ETFs are investment funds that are traded much like stocks on global stock exchanges. They bundle together multiple assets such as stocks, bonds, or commodities into a single package that investors can buy or sell. The beauty of ETFs is that they offer a simple way for investors to diversify their portfolios without having to buy each individual security. Now you might be thinking, don't mutual funds do the same thing? Well, yes and no. While both ETFs and mutual funds bundle assets, ETFs differ in a few key ways. Firstly, ETFs can be bought and sold throughout the trading day at fluctuating prices, just like individual stocks. Mutual funds, on the other hand, are only priced at the end of the trading day, so in a nutshell, ETFs are a type of investment fund and exchange-traded product traded on stock exchanges. Now let's delve into the structure of ETFs. At its core, an ETF is a type of fund and exchange-traded product, which means it's traded on stock exchanges. ETFs are structured in a way that they hold underlying assets, usually a collection of securities like stocks or bonds. These assets are divided into shares, which investors can buy or sell. Each share represents a proportional stake in the fund's total assets. What makes ETFs particularly intriguing is their design to track indices or assets. Essentially, an ETF is constructed to mirror the performance of a particular index or asset, like the S&P 500 or gold. This is accomplished by holding the same components as the index or asset it's tracking in the same proportions. ETFs provide a way for traders to invest in a broad market or a specific sector without having to buy each individual security. That's how ETFs mimic the performance of an index or a particular asset. Did you know there are various types of ETFs? Indeed, the world of exchange-traded funds is not one size fits all. Let's start with equity ETFs. They primarily invest in stocks, providing a great way to gain exposure to a certain sector or region. Next up are bond ETFs, which invest in bonds and offer a reliable income stream. Then we have commodity ETFs. These are perfect for those wanting to invest in physical assets like gold or oil without the hassle of storage. Sector-specific ETFs, on the other hand, focus on specific industries such as technology or healthcare. These are ideal for investors who anticipate growth in particular sectors. Each type of ETF has its unique purpose and benefits. Equity ETFs offer potential for growth, bond ETFs provide steady income, commodity ETFs hedge against inflation, and sector-specific ETFs allow for targeted investments. These diverse types of ETFs allow investors to target specific sectors, asset classes, or investment strategies. One of the key advantages of ETFs is their liquidity. Now, when we talk about liquidity, we're referring to how easily an asset can be bought or sold without impacting its price. ETFs are traded on exchanges just like individual stocks, meaning they can be bought and sold throughout the trading day at prices that fluctuate based on supply and demand. This is referred to as intraday trading, and it's a key difference between ETFs and traditional mutual funds, which can only be traded at the end of the day at their net asset value. But who ensures this liquidity? Enter the market makers. These financial intermediaries buy and sell ETF shares to keep the market liquid. They help maintain a close relationship between the price of the ETF and the net asset value of its underlying assets, ensuring that investors can always trade their ETF shares at fair prices. This liquidity allows for flexibility and ease of trading throughout the day. It's important to understand the costs associated with ETFs. One of the main costs you'll encounter is the expense ratio. This is the annual fee that all funds or ETFs charge their shareholders. It represents the percentage of your investment that goes towards running the fund. It's typically a small percentage, but it can add up, particularly for long-term investments. Another cost is the management fee. This is included in the expense ratio and is the money paid to the fund's manager for their services. Again, this is a percentage of your investment. How do these costs affect your returns? Well, they're deducted from the total returns of the ETF. So if an ETF had a return of 5% and an expense ratio of 1%, your net return would be 4%. Remember, lower expense ratios can lead to higher returns over time. I hope you're finding this content informative. If you are, it would mean a lot if you could hit that like button and subscribe to the channel. It's your way of saying, keep up the good work. And it helps me bring you the best financial content. And hey, don't forget to chime in on the conversation. Have a video suggestion? Drop it in the comments section. Your support means the world to me and will enable me to improve the quality of these videos. Let's talk about the tax advantages and the creation process of ETFs. One of the many reasons ETFs are an attractive investment option is their tax efficiency. Unlike traditional mutual funds that may generate capital gains distributions as they buy and sell securities, ETFs are structured in a way that allows investors to avoid most capital gains until the shares are sold. This is primarily because when an investor wants to sell their ETF shares, they are typically sold to another investor on the open market rather than being sold back to the fund. This means the ETF itself doesn't have to sell any of its holdings, thus avoiding generating a taxable event. Now let's delve into the creation and redemption process of ETFs. This process involves what's known as authorized participants, or APs. These are usually large financial institutions like banks or other investment companies that have the ability to create or redeem ETF shares. Here's how it works. When demand for an ETF increases, an authorized participant can create more shares. They do this by buying the underlying assets that make up the ETF and delivering them to the ETF provider. In exchange, the ETF provider gives the authorized participant new ETF shares. On the flip side, if there are too many ETF shares in circulation relative to the demand, an authorized participant can redeem them. They do this by buying the ETF shares and delivering them to the ETF provider. In return, the ETF provider gives the authorized participant the underlying assets. This creation and redemption process is conducted in large blocks, often involving tens of thousands of shares, which helps to keep the price of the ETF in line with the value of its underlying assets. What's more, this process is also in kind, meaning the APs exchange securities for ETF shares rather than cash. This in-kind process is important as it helps to limit the capital gains distributions that can be triggered when assets are sold, thereby contributing to the tax efficiency of ETFs. So not only do ETFs offer a way to diversify your portfolio, but they also come with tax advantages and a unique creation and redemption process that helps maintain their market price. This unique creation and redemption process contributes to the tax efficiency of ETFs. ETFs offer a great way to diversify your portfolio and manage risk. Let's break it down. Diversification, in essence, is spreading your investments across a wide range of assets to reduce exposure to any single one. ETFs excel at this as they inherently represent a broad spectrum of assets, be those equities, bonds, commodities, or even entire sectors. However, like any investment, ETFs come with their own set of risks. Market risk, for instance, is the potential for an entire market to decline, affecting all assets within it. There's also liquidity risk, which is the risk that an ETF may not be easily sold when you want to exit the position. But fear not, these risks can be managed. By understanding the assets within an ETF, the sectors it represents, and keeping a keen eye on market trends, you can better navigate these risks. To put it simply, knowledge is your best tool in risk management. Remember, diversification is a key strategy in risk management. We've covered a lot of ground today about ETFs. We've delved into what they are, how they differ from traditional mutual funds, and their structure and components. We've explored the various types of ETFs, equity, bond, commodity, and sector-specific, and their respective purposes and benefits. We've discussed how ETFs offer intraday trading, the role of market makers in ensuring liquidity, and the costs and expenses associated with them. We've highlighted the tax advantages of ETFs, the creation and redemption process, and the role of authorized participants. We've emphasized how ETFs provide diversification across multiple assets and the risk factors associated with ETF investment. We've provided examples of well-known ETFs and their market performance. Finally, we've guided you on how to invest in ETFs, explored their use cases and investment strategies, and explained how they are regulated. If you found this information helpful, please subscribe to this channel, like this video, and share it with others who might find it valuable. Your support enables us to keep producing quality content like this, and it means the world to us. If you have any suggestions for future video topics, don't hesitate to leave a comment down below. Remember, understanding ETFs empowers you to make informed decisions about your investments. The more you learn, the better equipped you are to navigate the financial markets. Thanks for watching, and remember, knowledge is the first step to successful investing.